Hi, everyone. This is Jason Barack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I like to have him on every couple months, basically every quarter of the year, for an update on the oil market, the natural gas market, and the other energy markets. He has 20 years of experience in the oil and energy markets. Robert Rapier, thank you for joining me again.
Thanks for having me back, Jason.
Now, Robert, we had the nice rally in the oil markets from I think where we touched around $43 a barrel 4 or 5 months ago. Then we rallied, I think, back up to maybe around 65, 70 at one point. And we're back down. I think yesterday we touched 44 again. And, all the people, all the mainstream oil analysts and the people who look at a chart, they're saying oil is going to go much lower. Do you think from a supply perspective with production costs, are we looking at a lot of bankruptcies here in the short term?
I don't know about short term, but I think the supply demand. I told somebody the other day in the oil markets there's two pieces. There's the actual literal supply and demand, and then there's market psychology. And if you look at the supply demand situation right now, supplies are going to be going down. And I think market psychology thinks the supplies are going to be going up. You're going to be seeing the production in the U.S. start to decline. We're seeing week-over-week declines now at this point. If you take a little bit longer view over the past 6 months, you're still seeing a little bit of a rise, but it's much, much lower than it was. And we're going to see oil production decline, and that's a problem because 85% of the new oil production in the world over the last 5 years has come from the shale oil fields. So the actual supply and demand over the next year, yes, there's going to be, some exports from Iran are going to come on the market, but demand is going to go up. The IEA estimates by another 1.3 million barrels, and U.S. production, the source of all the new oil, is going to decline. But the market psychology, the investor psychology is, hey, we've got inventories high and barrels are coming from Iran to make the situation worse. So we have once again pushed oil down to a price that I don't think is sustainable. I don't think it's 43.80 right now. I don't believe that number is sustainable. Again, I predicted this year.
I don't either. I agree.
I predicted this year we wouldn't close below 40, and we've taken. I think this is the third run at it now that we've taken, and it's riskier now than it was. I mean, I was more confident earlier in the year, but investor psychology is really, really soured. But I think that as people start to look at the supply-demand situation, people will start to pile in here. I think this is very close to bottom. And if we break into the below 40, I will shift money from other places into oil.
Yeah, I think we're close to a bottom, too, despite what a lot of the mainstream people say about the oil market. I mean, I'm surprised we haven't seen more bankruptcies yet. The last time we saw the oil price touch this low a number of months ago, we saw a lot of emergency capital raises from some of the higher-cost shale producers, like Oasis Petroleum. Oasis was one of them, but the other one was Whiting Petroleum because they did that ill-timed acquisition of Kodiak Oil and Gas, and I think they had to raise $5 billion combination of debt and equity, and it was at very penalty rates. I was thinking at this time, if the price stays low enough for a while, the capital markets are not going to be as easy to go out there and sell those shares when they've already gone down so much and go out and raise debt. But we've seen evidence, on the supply side. I think the rig count 12 months ago, or a little bit more than 12 months ago, was 1,300 or a little above that. It had hit, a peak. An all-time high maybe of around 1,300 rigs. I don't know if that's globally or the U.S. You can correct me on that. But I think we're down right to around 600 now. So we've been cut more than in half, and yet we've had a little bounce back here, a couple extra rigs coming online, some coming off. So we seem to be bouncing around on the bottom here for the rig count.
Yeah, and that is so I'm looking at the graph right now. I wrote an article back in June, and it was called OPEC Crashed the U.S. Rig Count. Prior to OPEC's last November meeting, the rig count was right at 1,600. That's North American rig count. And within just a few months, the rig count dropped to about 600. So the fact that OPEC decided not to cut production, the oil producers in the U.S. said, okay, we could be in for a long ride here. And they really cut capital. They cut spending. They cut the rigs. And it's just a free fall after that OPEC meeting.
Now, I have an interesting theory on the OPEC. I see a lot of articles, whether it's oilprice.com or RigZone or some of the other main websites that do a good job covering the oil markets. I'm sure you're aware of all these ones, but I'm just trying to get our listeners that, I look at all these different websites for sources besides just your work, which is absolutely quality. I have a theory here. The Saudis have consistently put out the message, I guess, over the last 8 to 12 months that they want to maintain their market share. They won't cut their supply, like you said. How difficult do you think it would be for the Saudis or OPEC to say, what, we want to put a lot of these shale oil producers out of business. They're hurting our profit margins. They're taking market share. After that last rally, why don't we just hire, some of the largest investment banks on Wall Street? We'll pay them, $50 million or $100 million or something like that in consulting fees. And we'll pay them like to start a hedge fund and short the paper market, the futures contracts for oil price. And, the Saudis won't go bankrupt because they're the lowest cost producers. They'll obviously have pain, but the shale producers who have drilled a lot on debt, they're higher cost producers. And, they can't survive the low oil price environment as long as the Saudis. Do you think that's feasible for the Saudis to have attempted to do?
The Saudis can do a lot of things because of the position they're in. I think they sort of miscalculated, though, when they decided not to cut production last November. I don't think they anticipated that prices would fall this far and would hang around this level for this long. And I think that if they did believe it, they would have believed they would have totally just completely demolished the U.S. shale industry. And a lot of these guys are hanging in there. So I think Saudi miscalculated. They didn't do what I would have done. I mean, I always try to think about things from if I'm sitting in their shoes. And if I'm sitting in their shoes, I know that I still produce more than 30% of the world's oil as OPEC overall. And that if I cut production by 10%, yes, I'm going to lose some market share, but I'm going to drive the price of oil up by 30%. Or I'm going to keep it at $90 to $100 a barrel. That's what they could have done. They would have lost some market share. Maybe they lose 10% market share, but the price of oil is going to be twice what it is today. So they miscalculated. I think they're looking at the long game, but I think the rest of OPEC is grumbling about what has happened. Everybody in OPEC needs oil prices higher than they are right now to balance their budgets. So
well, not just OPEC, Robert. I mean, the deep water guys are in trouble. Shale, a lot of the shale guys claim that their costs keep dropping, but we don't see, positive financial statements coming out from them. Maybe that's interest expense on their debt. But, most of the evidence here is I'm not sure how much global oil production can survive at these prices. There's probably not that much that's in the green right now.
No, that's absolutely correct, and that's why, to me, when oil prices get down to this level, it is a buying opportunity. They cannot stay here. They can. The oil markets can be very irrational in the short term, but when they are irrational, that's when you need to step up.
Yeah, I completely agree. And, we said that last time. I think I had you on a number of months ago, maybe around March or April, and we did have that nice rally. So we saw that coming, but then I didn't expect that we would be back down here again retesting the lows. But I think eventually, we are going to see either consolidations. Kent Morris wrote a good article. I don't know if you follow his work, too. He's another oil expert I follow. He wrote an article recently. He expects a lot more this week, that he expects a lot more consolidations in the industry because the companies that can't raise the money and maybe their hedges are coming offline or they have too much debt, they're not going to go bankrupt, but he expects them to, start making the phone calls now to be willing to sell out to the larger companies in the near future.
Yeah.
You also wrote a good article recently this week about oil reserves. So we have a lot of the larger oil companies, they borrowed very heavily from the debt markets to pay good dividends, and those are some of the best dividend payers available right now. They have low price-to-earnings ratios. Chevron, I think, profits are down, 90% in the last couple of years. You expect now oil reserve write-downs. How bad of losses are these things going to be going forward?
It could be pretty significant. Some are taking write-downs now. There are some that have been already saying they've had to lower the value of their reserves. But when it's really going to hit is the end of the year, because the SEC requires them. They require a calculation called the standardized measure, and most people are familiar with it as the PV10. But I don't like the PV10 because companies can play games with that, and they can do different things. The standardized measure is a gap measure, and it requires companies to calculate based on their proved reserves, which is a function of the average price for the year. It requires them to say, okay, the wells, the reserves that I have now that are developed or that are undeveloped but will be developed within 5 years at the current price, and they calculate the cash flow, the projected cash flow. And so a company should be at least as valuable as the estimated future cash flows if you trust the estimates. The problem is all those estimates were done, the average price they used, and I've looked at quite a few companies, was still above $90 a barrel. And it's 50 now has been the average for the year. So you're going to see companies have to come to grips with how much of these, especially proved but undeveloped reserves, am I going to go ahead and develop if oil is at $50 a barrel? And it's going to be a lot less than it was at the end of last year, where, oil prices were low, but the average for the year was still, pretty high and still let them, claim pretty high reserves. So you're going to see some pretty big write-downs, I think, at the end of the year.
That's interesting. And then that's the question then of whether or not those write-downs are already priced into the stock price of some of these companies and with the higher with the higher reserves and who are going to have to do the write-downs.
Well, there absolutely some of it is priced in, because if you look at the enterprise value to standardized measure, it is below 1 for a lot of oil companies. In fact, it's as low as 0.5, 0.6 for some oil companies, and that would say you can buy that company for 60% of what their reserves are worth right now. But that's going to come down at the end of the year now. After they start putting out their annual reports, if you see companies that are valued under their standard measure, that will be a buying opportunity for companies, because once they've written down those reserves, you got to see who's still undervalued after those reserves have been written down, and some companies will be, and I'm keeping an eye on that.
Yeah, it's looking like we're going to see some dividend cuts. I mean, I don't know if we've seen mass amounts of dividend cuts from the large oil companies yet. I don't think we have from ExxonMobil and Chevron.
We haven't, but some of them are funding with debt now. So Chevron, ConocoPhillips, they could not fund their dividend out of cash flow. In fact, as companies have been announcing earnings, I've got a spreadsheet here that pulls in all kinds of metrics from Standard Capital IQ, S&P Capital IQ, and nearly every company for the last quarter had negative free cash flow. I mean, nearly everyone. If I scan down the list here, I see, one here and there, and they're small companies that are not on most people's radars, the one that did have positive free cash flow. But the big guys, every one of them's got negative free cash flow for the quarter.
Now, most of these oil producers, Robert, I want to talk about hedging. We've seen some of the shale oil producers hedge over. I think they hedged in the last 18 months or 24 months, and have probably saved their butts. So they didn't have to go do emergency capital raises. They didn't have to do, sell the company immediately out for pennies on the dollar to a larger company, a fire sale price. And we haven't seen the bankruptcies, you said, but a lot of these, in my opinion, have been done. These companies have been saved due mostly to hedging. Have these larger companies then, have they hedged a lot of their oil prices? Because it seems the shale producers, they drilled on debt, which the old saying in the oil market is the oil men are taught not to drill on debt. And yet these guys in shale did, but they hedged their oil prices like 2 years out at $80, $90 a barrel and stuff. But it doesn't seem like a lot of the other oil producers, the larger ones, hedged.
Yeah, and most of the big guys won't hedge. Some of them, especially the MLPs, will hedge because they're trying to get a steady, predictable source of distributions for investors. So those guys will hedge. Lynn Energy was pretty hedged. That was always one of the attractions, was that they were hedged out several years, but those hedges are coming off now, and that's a problem because now they can't hedge where they did without spending a lot more money to do that. So they either hedge at a lower level, which affects their future distribution, or they pay more money to hedge, which affects their future distribution. So, but the ExxonMobils and stuff, they won't hedge or won't hedge much. They'll just ride up and down with the price of oil.
That's interesting. Actually, you brought up Lynn. I follow the company very closely. I looked at their cash flows. I don't know if you know Dan Steffens over at Energy Prospectus Group, but he actually had the cash flows for Lynn out with the hedging, and they're actually very well hedged. I think I saw articles out this year. They were very well hedged for the next 18 months or so. But I guess I think the company was just so worried about lower oil prices. I think it was preemptive move to cut the distribution like completely down. But there's so many other, MLPs, like you said, whether it's Memorial Production Partners. I think the consensus in the oil industry was that Memorial Production Partners was the most hedged of any company. I think they hedged like 2 or 3 years in advance at over $90 a barrel. So I'm wondering then if Lynn Energy, because Lynn was considered, one of the top 5 best hedged companies in the whole United States for oil prices. I'm wondering then about some of these other oil-producing MLPs that also hedge then, if they're going to, because their stocks probably also got hammered when Lynn got hammered, if they're going to, just bite the bullet now and just, figure that anyway that they have to write off the debt and pay off the debt now anyway.
Yeah, I mean, some of them will. Some of them won't survive. Eagle Rock, they're getting folded up. There'll be some that probably just won't survive here. I'm just scanning across. In my spreadsheet here, I've got the E&P MLPs. I've got the upstream MLPs in here, and I'm just scanning across to see what they look like. Some of them, let's see. Blackstone looks.
I was only mostly talking about the bigger ones, like Brightburn or Vanguard or Memorial Production Partners. Yeah, I mean they were I think all 4 of those guys, including Lynn, I think they had over 70% of the oil production was hedged for at least the next 12 to 18 months. But I think like they took out so much debt when it was cheap. I guess the market is just worried about the total debt levels, and I guess they're just going to pay off debt for the next year or two, and then I guess they're hoping that they can rehedge then at a higher price with less debt in the next year or two or something.
Yeah.
Yeah, another company, Robert, and you wrote an article on this, and we were talking about this before we started recording, is Petro Bras. I look at Petro Bras' financial statements now, and they scare the crap out of me without sugarcoating it. They have $270 billion in debt on their balance sheet and only $40 billion in equity. That's almost a 7-to-1 debt to equity ratio for an oil company. That's a super leveraged balance sheet there. What do you think has gone wrong then with Petrobras? Because I thought they claimed that they could do very well at $50 a barrel oil in the past.
Yeah, the problem with Petrobras is that the government has raided the coffers, and when times were good, the problem with the oil industry, it's very capital intensive, and this is what people don't understand. And so when the times turn good, so we have bad times right now, but when times turn good and profits come in, oil companies make a lot of money. They will reinvest a lot of that money. But when you've got when you've got Hugo Chavez, which he did down in Venezuela, or Petrobras, the government there did the same thing. During the good times, they start to siphon off that money for other things. And so then when times turn bad, they really bad because, they can't live off the capital that they've employed because they weren't employing enough capital. So, that's the thing about a lot of the big guys, because they have reinvested so much. They can slash their capital spending to survive some of the tough times, and then live off the capital spending from the past few years. But not if you have underinvested. That's the problem with in Venezuela. That's the problem with Petrobras. That's the problem with a lot of these countries. There are people in the U.S. that would do it too. Whenever oil companies have the windfall profits, they don't remember that there were years when it was very, very bad, and so they use those windfall profits generally to plow back in and invest when it looks like times are going to be good. And you've got people who would grab that money, and the result wouldn't be good. You'd see a rapid deterioration in crude oil production over time if people did that.
Yeah, this is what governments do all across the board. They just get greedy. So when the gold miners, I don't know if you followed the gold miners, but when the gold price was much higher, the gold miners weren't reporting their real costs. They weren't reporting their all-in sustaining costs. They were only reporting their cash costs for mining gold, right? So they in all their financials and PowerPoint presentations and things like that, when the gold price was at 1900, almost 2000, the gold miners made it like they were, minting money, making massive amounts of money when they really weren't. They were making pretty good money, but not mass amounts. So the foreign government saw, these financials saying, oh, we're producing gold at $600 or $800 an ounce cash cost, when in actuality their costs were much higher than that. The gold price was at 2000, so all these foreign gold miners got hit with massive taxes, or there were threats of, nationalization and stuff. So what you just said, with governments trying to go after more and more of the pie, it's not surprising. I think unfortunately it's the nature of governments to want to go after more of the surplus when they see it. I think Petrobras, though, you wrote an article about it in 2012. I had read it a while ago. You just sent me it again. we talked about Petrobras is basically being used as a piggy bank, but not only that, they're subsidizing, I think, the cost of oil, right, for the Brazilian consumer, so the consumer doesn't pay the full price of the oil at the pump, right? So Petrobras doesn't even recoup its costs to its domestic market.
Right. That's exactly what's happened. The Brazilian government, who is the majority shareholder of Petrobras, has said, look, you're not going to sell fuel for cost, for full cost to citizens here because, we'd like to stay in power and we'd like to be reelected. So what happened is they forced Petrobras to sell under cost. Petrobras lost a lot of money. And the irony of this is that oil subsidies, I've written several articles on oil subsidies, and when people are tallying oil subsidies, anything that causes the price to not be full market price, so like in Venezuela where they're selling gasoline for 10 cents a gallon, any place like that, the difference between that and market price is considered a subsidy. So in Brazil, this difference in price, that was tallied as an oil company subsidy, but it was being paid by the oil company. So people were getting outraged that oil companies are getting all these subsidies when in this case it was actually coming out of Petrobras's pocket.
Yeah, that doesn't sound like a sustainable operation for me at Petrobras. I mean, I think they've issued a lot, billions of dollars at 100-year bonds. This looks like a bankrupt company. I mean, maybe the Brazilian government will bail them out somehow or someone else will come in and bail them out. But, these financials, and obviously these are the public financials with aggressive accounting, so we don't know what the real financials are necessarily, but the stuff we see in public with their financials and their debt and stuff, doesn't look like a sustainable operation to me, where the Brazilian government, uses Petrobras' ability to borrow debt a lot cheaper, and then they use that money on other government projects. This is not a sustainable operation for me, so I would avoid this company like the plague right now.
Absolutely.
I want to transition here to in terms of oil demand. I've heard other experts around say that oil demand has completely collapsed in China. What's your opinion on global oil demand? Because it seems to me with cheaper oil prices, in the U.S. we've seen evidence that more people are switching to SUVs again. It's the summer driving season. That we're going to see a stimulus in demand at these cheaper pump prices, unless you're in California where the taxes are heavy or something like that. But it seems to me that globally oil demand is still going to grow. And I think the statistics for new car sales, I think they're projecting about 75 million globally new car sales to be added to the global fleet in the next couple of years. And car sales in China are still pretty strong. Maybe the growth rate has slowed a little bit, but we're still seeing growth out of China and India and things like that.
Right. I mean, when people talk about growth, demand declining, they usually mean that growth is slowing down. But, demand growth has been strong for years and years. And whatever China, if they do slow down a little bit, you've got other countries that are picking up the pace. You've got India that's starting to pick up demand. You've got Vietnam. You've got other countries in the area that are rapidly increasing their demand. So, like I said, the IEA projects that over the next year we're going to increase demand by another 1.3 million barrels, which is consistent with what has happened over the last 20 years. We've increased demand by 1 to 1.3 million barrels a day for 20 years now.
Yeah, and that'll take us up. I think they're projecting us to go to around 95 million barrels per day in the next 4 or 5 years. That's a lot of barrels that have to be replaced. So I think the market is so myopic, so short-sighted. It's not thinking that, I think we're going to have to I haven't run the exact numbers recently, but, if we're consuming 92 million barrels per day now, and that's, 365 days a year, that's a couple billion barrels. That's over 3 billion barrels per year that we're going to have to replace. And the market just doesn't think about this right now. I think people are so worried about, meeting the Wall Street traders are so worried about, making each quarter or each month or each weekly bonus to beat that benchmark or something like that no one's thinking about this right now.
Exactly.
My last question for you is on the natural gas markets. Natural gas to me, I haven't heard a lot of major stories about it. It seems pretty quiet for right now. We had the bottom out period, I guess, a couple years ago, and the natural gas companies, I guess, have been restructuring. We had Carl Icahn go into Chesapeake Energy and, start selling off assets and trying to repair the balance sheet and stuff. How healthy do you think the natural gas market is in the United States right now?
They're having a tough time too. The situation this year was clearly coming out of winter. We were in much better shape on natural gas inventories than we were a year ago. So the only thing that was really going to drive gas demand up over the summer was a very hot summer. And summer's been, I guess, pretty normal this year. So our inventories are right square in the middle of where they should be. So, short-term natural gas prices are always very, very weather dependent. So there's really no drivers that you can see, short-term on natural gas unless, again, we have a very cold winter like we did 2 years ago. Longer term, I think there's a lot of drivers for natural gas. So, this is also a sector that I think if you're slowly accumulating shares, 5 years from now, you'll be glad that you did, because we've got a lot of chemical manufacturing plants that are moving back to the U.S., and that's going to increase natural gas demand by a lot. You've got LNG export terminals that are starting up. And again, back to the investor psychology, you're going to see investors that see that we're starting to ship LNG from Cheniere late this year or early next year, and I think that'll have an impact on the price of natural gas too.
Yeah, and we haven't had a huge supply overhang in terms of like a whole bunch of new natural gas wells that are pure natural gas that have been drilled. We've had a lot of, I think the rig count on the natural gas rigs have been down a lot, but there's been an increase in the natural gas, right, because it's been a byproduct of the shale oil. But with shale oil now in somewhat jeopardy and the oil rig count falling for shale oil rigs, the natural gas is also probably the supply is going to come offline too there as well.
That's probably correct.
My last question then before I let you go is about nuclear power. We've seen Iran claim that they want to add nuclear power plants, but we haven't seen a lot of other countries that at one point in the last 6 or 7 years claim to want to add nuclear power plants. China hasn't brought a lot of their power plants online yet. Germany and other parts of Europe seem intent now due to public backlash, not in my backyard syndrome, on wanting them shut down. Are you still bullish at all on nuclear power at all, or do you think that due to politicians and public sentiment and things like that, and seeing Fukushima, do you think then that it's going to take years for people to change their minds about nuclear power again?
I think if you look in the pipeline, China has a lot of plants that are being built. And, China and India, some of those countries, they're not going to have any other choice. I mean, it's coal or it's nuclear power. They are installing a lot of renewables, but they need firm power. And they're going to go with the cheapest power option that they have, and that would be coal, but they're going to come under a lot of international pressure over coal. And so there will be, China has looked and they've said, the future for us is nuclear power, and I think India thinks the same. So we still have a lot of excess uranium inventory to work through because of Fukushima and because, countries did, shut down reactors. But this year we did see an increase in nuclear power consumption from the BP Statistical Review. 2014 saw an uptick, and I think that was the first one since Fukushima, and I think you'll see that continue. But we've got inventory that's piled up that has to be worked through before I think you'll see the uranium industry recover.
Yeah, and to add to your points about coal, there is still some good amount of growing demand, I think, in developing countries for coal, but there's a lot of protests now on the ground in mainland China by the Chinese people who have asthma and other lung conditions that have, shortened their lifespan, I think, by about 10 years or more. So I think, the Chinese people are protesting now that they don't want coal-fired power plants anymore, that they've had enough exposure to bad air quality. So I think the Chinese government, their central planners, they're not huge on the free market, especially in the energy market. So because they subsidize solar panels and things like that. So I think we're going to see the Chinese government respond to the people that are protesting that they're going to start transitioning away from coal, it looks like.
Yep.
Okay, Robert. Well, I really enjoyed this discussion about the oil market. Do you think it's safe that where do you think it's safe then for people to be investing in the oil market right now? What types of companies or size companies or upstream, midstream, downstream MLPs? Where do you think it is safe depending on people's risk tolerances right now?
Yeah, you hit it right there. It's exactly dependent on people's risk tolerances. The MLP sector has gotten hit really, really hard, but it is the one of the top performing sectors over the last 10 years. So. MLPs look pretty good for, and that's, more conservative investors who are looking for long-term income. That is a sector right now that's on sale. The price of oil, I think, is going up. You look at some quality companies, EOG Resources would be at the top of my list. It's selling significantly under where, it was. And they're still reporting that they can make money at $50 oil. That's what they say. Some others have said the same thing, that if they collapse into the core of some of these shale plays, that they can actually make money at $50. And I don't think oil is going to stay at $50. I think we'll probably be up $60 or $70 a year, 2 years from now. So I'm investing for the long term, and I try to play the probabilities. What's the probability oil price will be higher or lower, and invest accordingly.
Yeah, I agree. I don't think $50 oil is sustainable for a whole bunch of reasons. I mean, there's just the CapEx has already been cut long-term on so many investments for future projects. We're going to have, with demand still increasing globally, unless we have World War III or another global economic crash like 2008, we're going to have demand increasing pretty much a lot going forward here in the next 5, 10, 15, 20 years. And I've heard some people say, they expect the oil demand in China to collapse, or they've already seen evidence of it collapsing. But I don't see evidence that the demand in oil for China has collapsed. I still see car sales in China still growing, although maybe not as fast as they were a number of years ago, but they're still growing.
Yep.
Okay, Robert. Well, I want to thank you for your time. I'll let you go now. Please tell our listeners where they can follow your work and read your great articles.
So I've got a blog called R Squared Energy. That's where I write about just general trends in the energy industry. I've also write a couple of columns for Investing Daily, one on master limited partnerships, and one on the energy industry in general. And then I write a subscription column for Investing Daily called The Energy Strategist. We have model portfolios, and we make buy-sell calls there, and we have outperformed the market, which is not there's not much to brag about there in this market. It's I've likened it to trying to swim up Niagara Falls. Yes, we've outperformed the market in up markets and down markets, but over the past year, it's the energy's been a tough place to be.
Not just energy, Robert. I mean, I follow a lot of commodities. Everything in natural resources and commodities is getting clobbered right now. It's been this way. Oil wasn't as bad as some of the other commodities, but we're seeing copper nosedive now. The precious metals got nosedive first, and agriculture got clobbered a lot too. So we're seeing the commodities pretty much across the board now, with copper and oil kind of being the last to fall. We're seeing huge drops in natural resources across the board. But we've gotten now to the point where in a lot of these markets, whether it's gold and silver, oil, where I don't think it's sustainable for much longer, because we're so far below the cost of production, and, we have reality with supply and demand where these metals and other things in agriculture and energy are used, and they have to be replaced.
Yep.
Okay, great. Well, thanks again for your time, Robert, and I look forward to speaking to you again soon.
All right, thanks for having me on again.